Hey traders, welcome back. Today is Monday, June the 27th, 2022. This is our weekly trading preview and market analyses. Let's go ahead and jump right in. I'm going to try to give you guys a little bit more information this week in terms of just data so that you can make up your own mind where we're going here in this marketplace. Are we going higher or are we going lower? There's a lot to look at. You know, as we look at our weekly technical indicators, we do use these 12 technical indicators along with the dual overlay of moving averages all the way from a 5-day out to a 200-day. We do still see that we're in that strong sell mode. Most of our pivot points are down below that 4,000 level, and it does look like the bear market is still in full force, although we're seeing some little green shoots popping up here and there, starting to get a little bit of help on the 5-day moving average, and we've recovered the 200-day moving average, again, on a weekly basis, not on a daily basis, but on a weekly basis, we have recovered that. So the question really is going to be this week, I think, can we continue to build on this, or do we sell back off? In other words, have we found a bottom, or is this just another bear market rally? But we'll talk about that here as we look at the market indicators. You know, one of the things that I talked about over the last 2 weeks has been the fact that this market has really just been coiling down here for quite some time. And that we have two basic types of markets. We have markets that expand and markets that contract, or markets that consolidate. We've been in that consolidation mode for a while. I said that obviously there's only one thing that follows consolidation, and that's expansion. We got that over the last couple of trading days. You know, it's interesting. We've had, I believe, 5 rallies this year that have averaged around 7% in this bear market channel. We've had about 5 rallies that have averaged somewhere between 5 and 8% on average. And so far, all 5 of those have failed, and we've sold back off to further lows. So the question is, can we hold this level? Again, is it a bottom that we're putting in here, or is it just another bear market rally? And I'm going to give you, again, some data to look at this week that will hopefully help you look at that. But, you know, the last 2 weeks there were fairly rare. It's been the most bearish that we have been since March of 2020. You've never, just 2 weeks of just absolute brutality in the marketplace. And then, of course, last week we reversed that with a 5%, a little bit better than a 5% swing to the upside. And so, again, the question here is, can the market make this into a run, or is it going to run into resistance? I'll give you my levels for today starting off. From a resistance standpoint, again, this is the E-mini futures contract that I'm looking at. From a resistance standpoint, 39.30 is a real crucial level, which incidentally, we're up about 15 points on the futures contracts this morning here. I'm filming this about 2.5 hours before the market open, and we're sitting right at 39.30. So 39.30 is the first big hurdle for the markets today. We're sitting literally 1 point above that right now. 39.65 would be the next level, 39.80 after that, and then the big 4,000 level up here. And so we'll see what the market can do with this. Support levels for me today, starting off our trading week, is going to be around that 3,900 level, just about 30 points below where we're at right now, then 38.65, and then all the way down to 3,800. So those are the levels of key support resistance that we're looking at today. Again, we are definitively in a downtrend, but we are pushing very, very strong to the upside in that downtrend. So today, tomorrow, Wednesday, I think these are going to be some definitive or defining moments for this market in terms of where it wants to go. As I mentioned, I believe that we're at this huge demarcation point here in the marketplace in terms of it deciding its future direction in these next, well, again, I'm going to say 3 days, Monday, Wednesday, Tuesday, and Wednesday. They're going to be pretty important in terms of seeing what the market can do with these levels. I will give you some other information, though, that, again, you can find what you want to look for. Your cognitive bias is always going to be there. I'll give you some information on why maybe we are headed higher, why maybe we are looking for a little bit more of a bullish trend. Give you some information on why I think that even if we are headed higher, ultimately are headed lower. This is an interesting statistic for me. We're off to the second worst start to a trading year ever. In the first 116 days. People don't really look at this as a market that is, in the same vein as the 2000 tech bubble crash or the 2008 financial meltdown, because it really hasn't had that type of a decline, but it has had a terrible start. And it's always a little bit of a crapshoot what happens over the next 117 days or the remainder part of the year. It's always a little bit of a crapshoot there when we have an ugly start to the year. But in terms of the full year performance, it doesn't look good. It doesn't look good overall, just from a statistical standpoint. Doesn't mean that we can't change that and that we can't have a banner second half of the year and finish with some positive numbers. But the trend, if you will, from a historical standpoint, doesn't look that good. Another thing that I think is interesting is that as you look across the board on earnings, we see that all of those earnings are pretty much here headed lower. Most earnings estimates, most earnings from companies coming in, they're not looking to expand, they're looking to contract. And that, of course, pulls down not only PE ratios, but pulls down valuations as well. And it allows stocks to drift lower as the earnings themselves come in at a lower level. We've had some really good earnings through the pandemic, and they've allowed the market to sort of stay buoyed. Obviously, the Fed has helped in that process as well. But earnings, one of the biggest drivers of where a stock goes over a longer period of time, not necessarily a short dated window, but a longer period of time, don't look good right now going forward. We are, as I said, in a clear bearish channel, but it's a very, very wide trading range. It's if you look historically here, going back over the last year, this is 2021 right here, you can see that, this was a very clear bull market, but the ranges were pretty darn tight. We had some ebbs and flows here along the way. Going into November of last year, we had a little bit of a drawdown, but you can still see the ranges were fairly tight. So while we are clearly in a bear market here, this range is an incredibly wide channel, and it allows for 200-point rallies in the S&P, and yet we can still stay inside of that bearish channel. So again, the question really for us this week is, can the market maintain this momentum that it has? Can it break out of this bearish channel? That would, of course, be incredibly bullish for the market. Or do we hit this resistance level like we have so many times this year and just then retrace back down to a lower low? One of the other statistics that I look at that I think is important and becoming maybe more and more so, back when I started on Wall Street in the 80s, retail traders had very, very little impact on the marketplace. And as you've had discount trading open up and now free stock trading and all these online trading platforms and the dissemination of news wires and information that basically can put a individual trader almost on the same level as a professional trader in terms of access to data, information, and infrastructure, retail traders have become more and more important in the marketplace. And this past week was the heaviest week of retail selling we have seen since September of 2020. So, it obviously, again, remains to be seen. Retail traders are the fickle group. They do not have, as we like to say, diamond hands. And it will be interesting to see if they can come back into this marketplace. But right now, You're not seeing that retail support in the marketplace. And it's important if you want to have a broad market rally to be able to have that participation. Another thing that's interesting, I'm not a big Elliott wave theorist. I don't really believe that much in Elliott wave. I don't believe that much in comparisons or overlays of certain market situations with current market situations. But it is interesting if you look at this overlay here. This is the orange line is obviously the first part of this year, 2022, and the blue line is leading into the financial crisis of 2008. I think more than anything, all it really points out is just that there is some potential for continued downside here, even though you had some nice upward movements. There were some moments in the 2008 crisis where we kept thinking, well, buy the dip, 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 and it really never served its purpose. And buy the dip has been a very, very workable strategy for years and years now. Again, it hasn't worked so far this year. We've had about 5 of these bear market rallies, and every single one of them has continued to sell off. So we'll see how that pans out going forward. Again, our monthly sector rotation, we don't have a lot of updates here simply because this is a monthly figure and this is more of a slower moving target, but we're just a week away here from getting a new figure, and we can make a comparison to the, instead of the April-May period, the May-June period, and it'll give us a little bit of idea maybe where the value is in this marketplace. If you're still wanting to go long, where's the best value to look for? We had 2 weeks ago, again, it was just another brutal week, and then of course this last week we had that big strong rally, and you could find some red in the marketplace, but man, you had to look really hard, and most of it was all concentrated in energy as energy continues to sell off. And one of the themes that really is the catalyst for driving this market, there's always a main catalyst. You've always got, it seems like a half a dozen news stories in the background that are market drivers, but there's always one that takes center stage. And right now, center stage news item is inflation. And one of the things that we are seeing, I believe, I've never met an economist that's very accurate very often. The Fed has not been very accurate very often. So it is just kind of a poke in the dark, if you will. But one of the signs that we are seeing, is energy, and a lot of the commodity softs are coming back down. Lumber, housing costs, construction materials, all these kinds of things are moderating. And so that's, I think, one of the big drivers that we have had in the market as of late is this fact that, hey, maybe this big bugaboo of inflation, it might potentially be moderating. Again, we'll see how that pans out over time. But 2 weeks ago, obviously, again, it was just a brutal 2 week period there that we went through. And then last week, we got that big snapback rally. Those are some big moves. Again, we haven't seen moves like that in a long time. We'll see if they hold. Again, we've had several of these take place. One of the things that I think is interesting is that on Friday, we had a big, massive green candle there. You can see how powerful that move was on Friday. And you know what? It was on the second lowest volume of the year day. That's not a good sign. That's generally not a good sign for the marketplace. Doesn't mean that it wasn't real, doesn't mean that it won't hold, but generally, if you're looking at this downtrend, for example, you want to see confirmation with volume, right? You want to see that volume building. This was a nice, selling volume confirmation of this move. You'd like to see that continue on the upside here, and we just didn't have it. Second lowest volume day of the year on Friday. A couple other things that I've already mentioned, but I just want to give you the actual statistics. We have had about 5 bear market rallies since January of this year, when the market sort of turned direction, went from a bullish to a bearish market. 9% rally, 7% rally, 12% rally, 6%, and then a 10%. The current one that we initiated here this last week, it's about a 7% in the SPY or the SPX, however you want to look at it. So again, all of these rallies failed ultimately, and we ended up going to lower lows. Will this one be the exception? Again, I think Monday, Tuesday, Wednesday of this week is going to be very, very important. One of the things that we look at is the put-call ratio. It's a way to gauge market sentiment. When the put-call ratio is above, when it is above 1, when put volume exceeds call volume, and it's below 1 when call volume exceeds put volume. So it's just a way to gauge market sentiment, right? When the put-call ratio is really high, trading at high levels, when sentiment is bearish, that means that the put-call ratio is high. Okay, so when it's really high, that's a bearish indicator. When it's really low, that's a bullish indicator. And you can see our week over week numbers here. A couple of things just to point out. Again, this would be 2 weeks ago, and this would be our numbers from last week. So you can see we've dropped from that 1.13 level to the 0.86 level. That puts us back in more of a bullish mode. But one of the things that I'm continually keeping my eye on is just how volume is drying up. Average volume, total volume was almost 7.9 2 weeks ago, 7.4 this week. We've gone down in open interest. You can see open interest contracts there versus open interest last week. So it's not a good sign for a sustained bull market when all of the volume and all the activity seems to be drying up rather than expanding. But again, we'll keep an eye on that. I will give you one very, very bullish scenario here going forward for this week, heading into the end of quarterly rebalancing. Now, this is out of JP Morgan, and this obviously isn't exclusive to JP Morgan, but JP Morgan has one of the largest trading desks on Wall Street right now, and as such, it has one of the deepest wallets. And so it votes, obviously, with its wallet, the way that it thinks, and it thinks that we're in a bullish scenario here. And so that's always something to look at. Whatever JP Morgan's doing, that's something that we want to keep an eye on. And they're saying that the stock market could surge another 7%. We could have another 7% rally this next week as we do get into that quarter end rebalancing in equities. And they expect rebalancing trades to favor equities after the year-to-date decline after this bear trend that we've had, where we've been down almost 20%. So they said next week's rebalance is important since equity markets were down significantly over the past month, quarter, and 6-month period of time. And you're going to see some window dressing. You're going to see some rebalancing. That, generally speaking, can be very bullish for the marketplace. Will it come to fruition? Again, I think we'll have a better idea here after the next 3 days come and go, Monday, Tuesday, and Wednesday. But one thing that I always follow very closely is a guy named Jim Rogers. I really, really admire Jim Rogers. I don't, as you guys know, like to predict where the market is going because I don't think that we have real crystal balls that work, and I don't think that we have the ability to do that. Every week we have somebody in our trading room say, after the fact, after a trade has been done, why didn't we do this? And the answer is always because we didn't foresee the future, right? We just don't know what's coming. But I will tell you, if I was 1/10 the trader of Jim Rogers, I mean, this guy has been one of the most successful traders to ever walk the face of the earth. That's not an exaggeration. He is one of the most successful traders to ever walk the face of the earth. He says that this is the worst bear market in his lifetime, which means it'll go down a lot and it will last a long time. He's a smart guy. I don't know necessarily what he's looking at, and I don't know what data he's processing to come to that conclusion, but he certainly had a ton of experience in the marketplace, and his track record is pretty much impeccable. It's pretty much impeccable. So I don't know. It's just data that we have to process and try to understand. We look at the open interest gamma spots on the S&P. Now, this was pulled from Friday's close, which was, again, about 39.11. We're just up above that right now, around 39.35. But you can see a couple of big changes this week in these areas, you can see, number one, that we've got a lot more open interest in higher strike prices. We haven't had that for quite a while. And you can see that for the first time in a really long time, we're starting to build a lot of call volume in here as well. Of course, that 4,000 wall is a big demarcation point still, but you are seeing a lot more bullish activity coming in now on our open interest areas. Expected moves for this week. Last week was a $1.20, and that's good. Anytime we're up above about 110 or so, that usually means we're going to have enough premium to have a decent shot at making decent returns on our 0DTs. This week, coming up is about 112 points. So again, kind of pulling back a little bit on the volume, kind of pulling back a little bit on the volatility. Again, that doesn't mean that we can't have another 2 sigma. We've had a lot of 2 sigma moves as of late, and it just because we're down on our expected move doesn't mean we still don't get another 2 sigma move for this week. I look at the heat map, and again, it just really illustrates what I've been mentioning a couple of times here. You can see that our stochastics have crossed over. They've hooked up. That's a buy signal right there. But we're still not there with the RSI. We're still not there with our Bollinger Bands. We're still not there with the MACDs or the histograms. In fact, our RSI right now on a 4-hour period is flashing a little bit overbought. Now that you never ever want to make a buy or a sell decision, a long or a short decision, just solely on RSI. RSI is a great tool, but it needs to be accompanied with other indicators. However, the RSI right now does look very overbought. Again, doesn't mean that that by and of itself means we should be shorting this market, but it is an indicator that we still haven't quite been able to break this into a definitive buy area yet. And again, I think these next couple days are going to be very, very important to look at. One of the things that we look at is the fear and the greed sentiment reading, and that takes into account a lot of things. You guys know I go through these every week, so I'll let you read them on your own for this week. But it is basically, for all intents and purposes, just a contrarian indicator, right? When we have really high extreme levels of greed, that's probably time to go. That's probably time to get out of the market. And conversely, when people are jumping out of buildings and everything looks horrible and the world's going to heck in a handbasket, that's usually a good time to jump in. So we've been knocking down around in and out, in and out, in and out of this extreme fear area. But last week's rally pushed us right back up again into the fear zone. There's no question that there's still some elevated concern in this marketplace because we are still in a very defined bear market, but we just are not getting the capitulation here that we talk about so often. If you look at the VIX and you look at the big bear markets that we have had, the 2000 tech bubble, right in here, you had a pretty high pop in the VIX. Obviously, 2008, it was massive. Coronavirus, that was massive as well. We're just not getting that type of capitulation in the marketplace. And this is one of the bigger statistics. As more and more time goes by, and we just don't see this happening, the question becomes, when is it ever going to happen? Because it almost always needs to happen. We need to have that capitulation to flush the market out so that we can get to new highs. So we'll keep an eye on that. But boy, we've been shorting the VIX. We've been shorting volatility in our AST program for most of this year. And it's been an incredibly successful trade for us. We look at my watch list for this week, and we're back into some earnings this week of companies that are a little bit higher cap, a little bit higher volume, a little bit better spreads. And I think all of these could present some tradable opportunities. So we've got stuff coming out today, both before and after the market closes on the 29th and the 30th. All of these have some pretty decent predicted moves on them, and they could set up for some nice trading opportunities this week. So I've got these stocks, these 6 stocks right here on my watch list for bonus trade opportunities for our trading room this week. you might want to put them on your watch list as well and just kind of make a note of when those earnings come out and what the catalyst is and how those stocks are trading. Could be some opportunities there for us to take a look at. Monday, today on trading, we do have durable goods out at 8:30 a.m. Eastern time. That's a potentially market moving item. We're back to our normal weekly routine here pretty much, where we're going to look at initiating a 0 DTE index trade today. And then we're going to come back to our IWM weekly credit strangle. We call that we're starting to call that the millionaire retirement account maker. 12 grand starting at 1% a week. In 9 years, you got $1 million basically. Doesn't mean we're going to have a 9-year run. You never ever can make guarantees like that. But boy, that's the track we've been on. And it's been a powerful trade for us. Back with our 4 DTE trades, we had some nice success with those last week by taking early profits and getting out of them before the market took off like crazy on Friday. And then we do have an open oil trade today that has moved very quickly into the profit zone. We're using CL, and it's still got basically 3 weeks to go. These are monthly options. It's in the nice profit zone right now. We're going to take a look at that here today and see what we want to do with that. If we want to add to that, we've only got one side of the trade on right now. Do we want to add to it and potentially enhance the profits, or do we just want to book our profits on it today? And that would give us a little bit more flexibility to wait later this week for oil inventory numbers to come out and maybe reset the trade. So that's kind of on the agenda today. We always want to look at an overnight index trade at the end of each trading session. We haven't had too much success in the last week of getting those in, but I think that this week might pose some better, clearer, maybe cleaner opportunities. And so I'm a little bit hopeful this week that we might be able to see some more overnight bonus trades. That's our activity list for today. On Tuesday, we've got consumer confidence coming out in the morning. That can be a market mover. On Tuesdays, we start our 0 DTE with a little bit different setup. We're looking for a very low capital commitment to the trade, just a few $100s, something that's very, very easy to overlay if we need to, and a little bit easier to manage because we're not in the Zoom sessions on Tuesdays. We will be in the live scalping room on Tuesdays scalping. But we do have a NVAX trade that we've had to roll twice now. Had to roll it at a debit last week, and so we need to do some work on that still this week to try to bring that back into the overall profit zone. And again, we'll take a look on Tuesday for an overnight index trade now that we do have the weekly, everyday SPX options. On Wednesday, we've got a couple of things coming out. We've got the US GDP numbers out early in the morning. We got Fed speak all morning long, actually trickling a little bit into the afternoon hours. And then we do on Wednesday have crude oil inventory numbers coming out. So we'll have to take a look at those numbers today, where we're at on the oil trade, and potentially book the profit or add to it. My inclination right now is that we'll book our profit on that and then come back here on Wednesday and potentially add to our 0 DTE trade with another oil trade. But we'll take a look at that here this morning. And then again, another potential overnight trade. We want to look at that at the close. Thursday's trading activity, we do have jobless numbers out. That's always, well, not always, but usually pretty big marker for the market. Can be a mover if the numbers are out of whack more than we generally see. So we'll see what those numbers do for the market as we get started on Thursday's trading days. We've got natural gas numbers out. We've got a nat gas trade on right now that is in its last month of expiration. So these are going to be very closely watched numbers for us as we watch our nat gas trade. And then we've got the commodity softs finally reporting their sales numbers. And we were able to get out by the hair of our chinny chin chin, a very small slight profit on our rolled soybean trade. If you watched the market review video that I put up yesterday, I was very unhappy with my discipline on that trade. But you know what? I'll take it. We were able to exit at a very small profit, and it gives us the ability now to reset. So I'll be watching the commodity soft numbers out on Thursday very, very closely and that might give us an opportunity there to get started back on some more commodity trades. I would really, really like, very highly desire here to get back into more trades that, as we like to say, are in the market, but not of the market. Commodity trades, things that don't necessarily move up and down with the market itself. And that can give us a lot more stability in our overall portfolio. So looking forward to Thursday. Obviously, we'll be doing 0 DTE again, starting with that butterfly approach or broken wing butterfly approach. But again, the idea on Tuesday and Thursday trading sessions with our 0 DTE is to do a very small initial capital outlay. And if that works, that's fantastic. It's a very low maintenance trade. And if it doesn't work, it's a very easy trade to overlay and fix and still potentially bring it into the profit zone. And of course, on Thursday, we'll be in the scalping Zoom feed all day long if you want to come scalp with us. Looking again at an overnight index trade. Friday activity, we've got ECB and Fed members speaking all morning long before the market opens up, before cash open. We do have some commodity soft numbers coming out as well. And then we've got new home sales at 10 a.m. Eastern time. And we've had a lot of movement. And I will say that I've been wrong. We have had a lot of movement in, the XHB and really anything related to home sales. Home sales have started to see a little bit of a top, and obviously interest rates are shooting up, and that's not favorable for real estate prices or home sale activity. But man, we've had some strength. We have had some strength in the home sector, and so it'll be interesting on Friday to see if that continues or not. Obviously, we focus on a 0 DTE on Friday, and that's all we try to do on Friday. By Friday, we are usually pretty worn out from trading, and so we want to try to keep it as simple as possible. Obviously, we have a lot of expirations that happen on Fridays from time to time, so we want to be able to handle those as well. So that's what our focus will be as we go forward. Now, updated performance results, as we look at our numbers again, unfortunately, we did take a loss last week on one of our 0 DTEs. So we're up to of 120 total trades that we've taken this year in 0 DTE. We have 116 winners, 4 losers. Remember again, if you are new to the trading room, that we do record each one of those sessions, and you can watch that video on the link inside of Discord. Just go to the top of Discord, click the little pin, and you can go down to a drop-down box, and they're all lined out for you there to click on and watch. Our 4 DTE SPY and Q trades, again, we're very, very pleased with those. We booked an early profit on both of those. There was a little consternation and gnashing of teeth in the trading room from last week on, why are we booking profits on these when they look so perfect and there's still, 50% capture rate left in these. And again, you either look like a genius and a prophet, or you look like an idiot in hindsight. But in this case, we looked like a genius. It was a very, very wise move for us to pull those off early. It would have created some problems for us on Friday's big move. But we booked some profits on those, so we're up to 86 wins, 7 losses on those. Our IWM Weekly Credit Strangle continues to be flawless, just absolutely flawless. There is very, very little that we can ask for anything, right? We can ask to turn $1,000 into $1 million. I mean, you can ask for whatever you want, but I will say there's very, very little that we have as traders that you can honestly ask above and beyond what we're getting out of our IWM trades. They are just absolutely picture perfect so far this year. Hopefully that didn't just jinx them. Our pairs trades, we were finally able to get out of one of our last remaining pairs trades at a whopping $2 profit on about a $280 investment. So it wasn't a very powerful profit, but one of the things that I think it wasn't a powerful profit, but it was a powerful example of how cool pairs trades are. This idea that, number one, they do not have any relationship, or they shouldn't have any relationship to what the market's doing. Market, Dow can crash by 1,000 or go up by 1,000. It doesn't affect how a pairs trades performs. And number two, I think when you get a pairs trade like this very last one that we had that really wasn't working, you can ratio it a little bit to move it, to push it, to nudge it into the profit zone. And so again, it wasn't anything that was, something to write home about, but it was a profit. And we're at 19 winners and 0 losers so far this year on the on the pairs trades. Bear market trades, we were able to book a profit there. So that moves us to 66 winners and 3 losers. These are harder trades to find, but boy, they've been really, really powerful. We do break out our Tuesday, Thursday 0 DTEs separately from our Monday, Wednesday, Friday days because we do approach them in a different manner, and we do usually input a different level of capital, and we do look for different results ROI wise. So it is a different breed. It's a 0 DTE day, but it's a different breed than what we've got going on Monday, Wednesday, and Friday. And it's added some nice diversification to our overall portfolio mix. But we did have only one trade because we had a shortened trading week last week. We only had one additional one of these trades that we added to our results, but it was a profitable trade. Nice trade. It's up about 15%, so it worked out quite well for us. Our scalping results, I've got 2 big open positions right now. When I say big, they're big relative to my portfolio size, capital-wise, but I've got 1 short ES contract and 1 short NQ contract, and I've been cash flowing those, but obviously with the market push up on a short position, these are not looking very favorable right now, but the cash flow is, and so hopefully I can continue to work that cash flow this week as I sit around and patiently wait to see if this bull market run can actually turn into a bull market, or if it is like the previous 5 bear market runs that we have had, bull market runs that we have had in this bear market, and we just end up holding off, hitting resistance, retracing back down, and hitting new lower lows. So I'll be working on both of these today to continue to cash flow those. My goal is to bring in about $4,000. Each one of these positions is about $15,000. I'm going to use our little payday loan strategy on these this week to buy a very far out of the money, very cheap call option to reduce that buying power down, so that maybe I've got something cumulative in the amount of about $20,000 between both of these. And my goal here would be to bring in about $3,000 or $4,000 a week, about $3,000 or $4,000 this week on each one of them individually. So that if I could bring in $6,000 to $8,000 this week on about $15,000 or $20,000 of capital, I would be happy or happier to continue to sit in these over the next few days as we let the market sort itself out. The AST system, again, this is our non-trading system. This is our portfolio management system, but it has been phenomenal. I want to give a huge shout out here to one of our trading members, Tim. He took the time. It's on my docket, guys, but I just haven't had a time to make a video for each one of these trading periods. But he took the time to actually plot out my performance, my net liquidation value of my actual account from February of this year. January, we've got that one posted on our YouTube channel, but February on forward, we haven't gotten these posted publicly. And man, you can just see it's just been absolutely awesome. In a market that is in a bear market that's down 20%, that asymmetric system has just proven to be absolutely awesome. So I'm just absolutely thrilled with the performance that we had in 2021. More than thrilled with the performance that we're having in 2022. Our Dragonfly and double diagonals, we didn't have any activity there this past week. Our Dragonfly and double diagonals, especially the double diagonals, they're a little bit like the bear market trades. They're a little bit harder to find, but boy, when we can find them and that they have such a nice setup and a nice ROI potential, we'll look for, again, some more bear market trades. We'll look for some more dragonflies here over the next week, see what we can find for next week's bonus trading sessions. But anyway, very, very happy with the asymmetric trading system. Bonus trading gifts. So I didn't get this video made yet, but I'm going to work on it tonight for you folks, and I will put it in the, again, the bonus training channel. But there's a very, very interesting strategy that I want to go over with you, which basically just talks about trading stocks overnight versus intraday. So kind of flipping the whole program around, if you will. Obviously, most people, if they trade overnight, it's very light. It's maybe a hedge for their portfolio overall, because you do have lower volume in the overnight sessions. And then obviously most of us are trading when the markets are open. This is a strategy that talks about only trading when the markets are closed. And you can see, going back to the early 90s, this has been absolutely phenomenal in terms of how much better the performance has been. You know, almost 1,100% return since 1993 with this approach versus what the stock market has done over that same time frame. And it's a very easy approach. It's not complicated. So I'll get that video made for you guys tonight. I'll get that in the bonus training channel. But it's an interesting strategy, and I think that it might be something that we want to incorporate as sort of a regular go-to trade inside of our trading room. So we'll chat about that a little bit more this coming week. If you want to contact me, I love hearing from you guys. So you can always, first thing that I would just ask is go to the YouTube channel. My goodness, you're watching it right now. You're on the YouTube channel right now. Scott Stewart Theta Seller is where you can find me on YouTube. Bookmark it. Click the notifications bell so that you know when we're putting new information out. Twitter is always an easy way to get a hold of me. You can direct message me there anytime you want. This is my personal email. It comes right to me as well. And you can join our private Facebook group. If you just search Trading with Scott, you can find our Facebook group there as well. So again, guys, I want to give you out a shout for all of the gratitude that I have for you guys. We took a loss on our 0DTE on Friday, and man, it was the first one in a very, very long time. And I've been telling you guys for weeks and weeks and weeks that mathematically our results can only get worse. They can't get better, because we were pretty much picture perfect. But one of the other videos that I'm going to put out over the next couple days here is continuing in the series of the number one thing that traders need to be successful, because the number one thing is different for everybody, but it's how to handle losses. It's how to work with losses. So look for that here in a little bit as well. We do have an absolute no risk guarantee. If you want to try our live trading room, you can jump in for a full week for free. Doesn't cost you any money. And if you do sign up for the first month and you don't find that it was life-changing, I'll give you double your money back if you follow the rules that we lay out for you. So I'll put some links for both of those in the description box below. And I look forward to seeing you guys in the trading room here in just a couple hours.